Silicon Valley Bank went from one of the most important banks in the tech and startup world, with over 8,500 employees and hundreds of billions in deposits, to bust in less than a week. Regulators have closed the bank and the FDIC has taken control of all deposits. Not that long ago, Silicon Valley Bank was a thriving, well-performing bank and an extremely popular stock, which was a long-time recommendation of our friends over at The Motley Fool, and as of just a few weeks ago was a stock Jim Cramer called one of the top-performing stocks of 2023 and an oversold bounce-back stock. So what happened to cause Silicon Valley Bank to completely fail? Is this going to spread like the fungus in The Last of Us and infect the entire banking sector before we are in a full 2008-esque financial crisis? In this video, we'll look at everything that happened and I'll explain the 2 fatal errors that Silicon Valley Bank made that ultimately led to its collapse. We'll also look at what this means for the greater banking sector and whether or not you should be worried about your deposits at your bank. So first and foremost, what was Silicon Valley Bank? Silicon Valley Bank was a bank whose primary focus was providing services to the many startups, founders, and venture capitalists in Silicon Valley. They were the bank for founders and entrepreneurs. So when these entrepreneurs, these startups, would receive funding from venture capitalists, a high number of them were using Silicon Valley Bank as the place where they'd hold their money. If your startup just got a load of cash from a Series A round of funding, Silicon Valley Bank was the place to put that money.
And Dunzo. Series bye-bye.
And the market for startups and venture capitalists was hot at the start of the pandemic years. From 2019 to 2021, Silicon Valley Bank was thriving. Its credit losses were low and deposits tripled from $60 billion in 2019 to over $190 billion in 2022. Sounds amazing, right? Bank loaded up with customers' money can only be a good thing, right? If you'll allow me to throw my accountant's hat on for a minute, I'll explain why that might not be as good of a thing as it may seem. Because when banks take money in from clients, that's money they owe the clients. For you, when you deposit money in the bank and it hits your bank account, that's an asset for you. For a bank, the money that you just deposited in your account with them is a liability. It's something that they owe you. And liabilities? Well, they cost money, both in the interest that the bank might pay you for holding your deposits in the account, and just with everything else that goes along in servicing an account. And as most of you are likely aware, banks just don't keep all that money sitting around in a giant vault doing nothing. Banks lend out your money, whether it's mortgages, car loans, small business loans, etc. And the spread between what the bank is earning on the interest on those loans and the money it has to pay you for interest on your deposits is, in the most simplest and basic terms, how a bank makes money. But remember, Silicon Valley Bank saw its deposits triple in just the span of 2 to 3 years. That's a good problem to have, but it's still a problem for the bank because they need to lend those deposits out in order to cover the costs of carrying them. And Silicon Valley Bank knew that it couldn't lend all of that money out responsibly in the form of mortgages or business loans or what have you. It was just too much money coming in too fast. So instead of being irresponsible and start lending out money on dumb and risky loans, they did what most banks do when they can't lend money out responsibly. They invest it. Now, they're not taking customer deposits and playing the stock market, but banks will do things like buying US Treasury bonds, or, I can't believe I'm going to say this in 2023, mortgage-backed securities. So that's what Silicon Valley Bank did. They bought about $80 billion worth of mortgage-backed securities with a yield of around 1.5%. They also bought loads and loads of US Treasury bonds, which, as we know from several other videos on this very channel, are extremely safe investments. Except, and this is going to be the first fatal mistake that Silicon Valley Bank made. These mortgage-backed securities they bought, and the treasury bonds they were buying, they bought extremely long durations. Most of the US Treasury bonds they bought had maturity dates of 10 years or longer. And like we learned in this video about bond funds, for every 1% rise in interest rates, you can expect the value of a bond to fall by about 1% multiplied by the duration of that bond. So if you're holding a 10-year bond, an interest interest rates go up by 1%, the price of that bond you're holding is going to fall by around 10%. And banks also use leverage when acquiring these assets. So those kind of losses will only be compounded by however leveraged the bank happens to be. So what Silicon Valley Bank did was they bought tons of high quality assets. They just bought them at extremely long durations and very low interest rates. So with each one of the Fed's interest rate hikes over the past year and a half or so, the value of these investments that Silicon Valley Bank made fell further and further, which obviously isn't a great situation for anyone to be in, a bank included, but it's far from being totally fatal on its own.
"'Tis but a scratch."
Because as long as the customers keep their deposits in the bank, and the bank holds those investments until maturity, everything will work out just fine. And here's where fatal flaw number 2 happens. Remember, Silicon Valley Bank's main customer base isn't people like you and me keeping our emergency fund with them, or just a bunch of local small businesses holding their business accounts with them. Their main clientele is tech startups and VCs. So as the economy starts to slow down and the interest rates started to rise, the giant checks and absurd valuations that these startups were getting during the pandemic years started to come back down to earth as well. So that means Silicon Valley Bank wasn't getting the massive cash inflows that it once was either. And this made the bank's belt feel a little tighter. So what they decided to do in order to give themselves a little breathing room, just to free up a little capital and improve their liquidity situation, was that they planned to sell off some of those investments at a loss of $1.8 billion. So even though Silicon Valley Bank didn't really have a liquidity problem yet, this move scared the out of investors, who reacted as if the bank was in deep trouble, because it probably didn't help Silicon Valley Bank's cause that they put a press release out announcing this same day that crypto bank Silvergate announced it was ceasing operations. So based on the poor timing of that news and the losses Silicon Valley Bank was willingly taking on to improve liquidity, investors sold off shares of their stock to the tune of an over 60% drop in just a couple days. Now, as you can imagine, that in turn spooked Silicon Valley Bank's clients. VCs started to reach up to their startup founders, telling them to get their money out of Silicon Valley Bank. And as all these startups and founders started trying to withdraw all their funds from the bank at the same time, that created a run on the deposits. Remember, these accounts at Silicon Valley Bank aren't your average bank accounts. The FDIC insures deposits up to $250,000 per account, and only 2.7% of the accounts held at Silicon Valley Bank fall under that FDIC insurance limit. That is near the lowest percentage in the entire banking industry. So the bad investments and the run on the bank led to financial regulators closing down Silicon Valley Bank and the FDIC taking control of all insured deposits. But the larger question on a lot of people's minds right now is this just the first domino in a line of banks that are going to collapse? Interest rate risk is one of the main risks you face when operating a bank. So it is a problem that other banks will be facing. But Silicon Valley Bank rather stupidly invested their deposits in very long-term bonds which carry a lot of interest rate risk along with them. Banks that, in theory, have more responsibly and intelligently managed their deposits and their investments should be safe. But that doesn't mean Silicon Valley Bank collapsing won't have ripple effects throughout the industry, as we're seeing with all bank stocks getting absolutely crushed on the stock market today. But as of right now, I don't think we're going to see this spiral into a 2008 style crisis like after Bear Stearns and Lehman Brothers collapsed. With Lehman Brothers and Bear Stearns in 2008, the main problem was the assets they were invested in were pure garbage. It's really not the case with Silicon Valley Bank. I mean, they were only invested in US Treasuries, and the mortgage-backed securities they held weren't the same type as we had back in 2008. So it's not the actual assets and investments the bank held that are garbage. It's more their risk management around those assets that was trash. So that's why I think there's much less of a likelihood of seeing a large systemic banking sector collapse this time around like we did in 2008. Banks are going to have problems if they're forced to sell bonds at losses and start realizing some losses on loans if and when the economy starts to worsen. So those are situations that might be putting other banks in trouble. But the risk of contagion throughout the banking industry, leading to a new crisis like the one we saw in 2008, at this point is relatively low. If you appreciate the research and the information that went into this video, I'd love it if you'd consider subscribing to the channel. Thank you for watching this video. Check this one out next if you're not sick of listening to me yet, and I'll see you next time.